everyone, and welcome. My name is Nathan Donohue, partner at Consilio Wealth Advisors, where we specialize in providing financial planning to tech professionals. And today we're going to be discussing an often overlooked component of a financial plan, our insurance portfolios, specifically property and casualty insurance. We've observed that many advisors do a fantastic job helping their clients accumulate wealth, but can sometimes totally drop the ball at helping them protect it. So today I'm joined by my good friend, Sophie Riley. Sophie is a partner at AHT's Private Risk Management Department. She works with clients and their advisors to customize insurance portfolios for successful families all across the country. Her expertise is in property and casualty insurance. Specifically, she'll review policies such as homeowners, valuable articles, auto, watercraft, and personal umbrella. Welcome, Sophie.
Thank you for having me.
Yeah, absolutely. Sophie, one of the first questions I wanted to ask was, and one that we sometimes get with folks is, what is an umbrella policy? And I think as a follow-up to that as well, is there a good rule of thumb for how much coverage people should buy?
Yes, and I would say that's actually probably the most frequent question that I get. A personal umbrella policy is a policy that sits over and above all of your underlying exposures and provides excess liability should you or a family member be found at fault in a catastrophic accident. So I'll give you some examples. When you're thinking of your property and casualty insurance, your home, your auto, watercraft, young drivers on your policies, all of these policies are going to have a limit of liability. Typically $300,000 or $500,000 is what we commonly see on a homeowner's or auto policy. Well, what an umbrella policy does is it sits over and above. So actually think about it as an umbrella going over above all of your exposures, right? And so if you add a jet ski, that would be extended as well, right? And so any of your personal assets you want to be protected by this umbrella. And as a rule of thumb, the more someone is worth, the more they may be sued for in our litigious society. And what we want to be considering when we're looking at the right amount of coverage is really, if someone Googles you, what would they potentially find?
Interesting.
And how much is going to be enough to get a personal injury attorney to settle rather than risking a lengthy court battle where your assets could be exposed? So I'll give you a few examples. I think it really helps to kind of break it down to some examples. And so this umbrella policy is going to come into play after the underlying coverage has been exhausted on a policy. So I'll give you an example. Let's say an auto accident. Let's say you're driving or a family member is driving and is considered at fault, is found at fault in a very large accident. Maybe multiple vehicles are totaled, lots of bodily injury, and so on. Well, the first step is going to be your auto policy, right? And the liability component on that auto policy is going to pay for damage to others. Well, oftentimes that's not enough to get a claim to settle, right? And so if you have $500,000 of liability, but one person has a severe injury, let's say they're paralyzed, right? Or there's a brain injury.
Sure.
A couple high value vehicles are totaled, right? Well, the first limit, typically our clients have about $500,000 of underlying liability on their auto policy. Once that is paid out, the umbrella will pay the remaining amount. And so what we want to do is we want to have enough to get them to settle. So we want to somewhat think about your net worth and your assets and your perceived net worth. So somebody who sells a company might be perceived as even having a higher net worth than they have, right? Or your property is also going to be something that is public record, right? And so if you own lots of homes, those are other things that you want to protect. So it's just a really great tool to protect your assets and your net worth in the event of a tragic accident. Another example that I like to mention is, auto is a common one that people would think about, but your homeowner's liability actually follows you worldwide. And when I say you, a homeowner's insurance contract defines an insured, and that does include all of your family members. Your household members are included for coverage.
Okay.
And so let's say you and your family are on vacation, and you fly to Aspen and you're skiing.
Yeah.
Well, one of your children decides to go in backcountry and has an accident. Let's say they injure someone who's maybe a child, and they're tragically injured while they're skiing, and it's an accident, but accidents happen. Well, your homeowner's liability would actually pay out in the event that you or a family member accidentally causes harm to another person, even when you're not at your home. All around the world, that's going to pay out.
Really?
It does, yeah. And
Interesting.
also don't know that. So sometimes if someone doesn't own a home and they're renting, they're like, oh, I don't care about my contents. I don't need renter's insurance. Well, it's not about the contents that's most important. It's the liability component that is most important. So that is interesting. And another one could be like if you're golfing and you accidentally hit someone in the head with a golf ball and they have a brain injury. Any kind of mishap that can happen, we want to make sure you're protected from a lawsuit.
Yeah, with my golf swing, that's probably going to happen. So that makes a lot of sense. No, the car accident example is the one I oftentimes use with clients because it just seems more real and more possible. But I wasn't aware. I actually was not aware of that with our homeowners insurance policies. That's really, really good to know. Okay, so this to just reiterate, this umbrella policy sits over all of your underlying individual policies to provide supplemental or secondary coverage in the event of I'm held to be liable in certain types of accidents. And as a good rule of thumb, I want it to be probably roughly equal to my net worth. And as I understand it as well, Sophie, there are some limitations on this as well. Like, Jeff Bezos isn't going to get an umbrella policy for $100 billion, right?
Right.
So
exactly. Yeah. And so what we typically say is, as a rule of thumb, you want to somewhat mirror your net worth up until about 10 million.
Okay.
A 10 million umbrella has a very high likelihood of a personal injury attorney settling versus risking a lengthy court battle. They want to settle also. 10 million is usually going to be enough to get even a somebody who's worth. Do you mind pausing it?
No, you keep going. We'll edit it out.
Okay. So I kind of wanted to say that differently. As a rule of thumb, we want to somewhat mirror your net worth up until about that 10 million range.
Okay.
And then you don't need to continue to increase it as your net worth increases over 10 million. There's some benchmarking data that we can look at. We do have some clients that might have a 20 million or a 30 million umbrella, but I would say Chubb Insurance, for example, they offer up to 100 million in excess liability in some situations. Typically, you can't get higher than that on a personal insurance portfolio.
Okay.
But usually 10 million is kind of that sweet spot where we want to get a personal injury attorney to settle. And somebody who's worth 20 million, for example, the chances of them settling for that 10 are extremely high.
That makes sense. What have you observed as the most often overlooked part of a really solid and comprehensive P&C insurance portfolio?
That's a good question. I would say the homeowner's policy, and in regards to that, I would say it's that dwelling replacement value. So many times, as a brokerage firm, we have access to many carriers, and I work as the advocate of the client. I work with all of the premier carriers in the marketplace, which are known for broader contract language, fewer exclusions, higher limits of excess liability, and so on. And so oftentimes what I'll do is I'll do a holistic review for a client, and I'll look at their current policies, whether, it's common to see State Farm or Allstate, they have a large portion of the market. And when I'm looking at those policies and I'm quoting them with the premier carriers that we represent and creating this nice cost coverage analysis that we do, I oftentimes will be surprised at what the dwelling replacement value is listed at.
Okay.
So
what does that mean?
Yeah. So on a homeowner's policy, there are going to be several different areas of coverage, and then it's going to tell you what that limit is. And so the number one is the dwelling replacement value. And then you'll see things like other structures, personal property, loss of use. There's some standard limits that are on all policies. And the dwelling replacement value, what that is it accounts for what it would cost to rebuild your home to like, kind, and quality in the event of a total loss. Okay.
Got it. So my house burns down to the foundation. What does it cost to reframe, rebuild it into roughly the same quality and equivalent specs?
Exactly. And a lot of times people will think that it's the same thing as market value, right? And I always like to remind folks that market value has many more factors than the insurance dwelling, and they're just different factors. So, for example, if you have a view of the water, that's going to impact your market value. Yeah. If you have a very large lot size, that's going to impact your market value. Dwelling replacement value, the big things to look at are going to be square footage of your home, cost of building materials, contractor fees in your area. Those are some of the kind of the primary factors, right? Yeah. And so each policy, we take a customized, approach. We look at the property. We have some systems that we can put the information in and populate around what that dwelling replacement value should be. And so that's the one I see the most often is underinsured, especially in like California. I'll see a policy and a home is insured with the dwelling replacement value is like $1 million. But in reality, to rebuild that home in today's market to like, kind, and quality would be like $2 million. So sometimes I see like a...
Interesting.
Yeah.
That makes total sense, especially with how much inflation we've observed with construction and people doing renovations. I mean, just costs have gone up dramatically. And so I could totally see how the underlying insurance wasn't keeping pace at that same rate.
Exactly. And then one benefit of the premier carriers that we represent, so some of the common ones you may have heard of would be like Chubb Insurance, Pure, AIG, Cincinnati Insurance, Private Risk, Nationwide Private Client, and so on. One of the big differentiators with those companies is that they are going to offer a broader homeowners contract. And the main highlights that I think are important to point out are going to be one, guaranteed replacement value on your home. So let's say somebody has a home that's, a $2 million to rebuild in today's market. We do a customized review, an appraiser goes out, verifies that value. Oftentimes we'll do a customized home appraisal for the insurance company. They'll come out and take photos and verify that
fit and finish and materials used, right? So I can't come out after the fact and say my entire house was built out of Italian marble. Like, let's actually document it.
Exactly.
Okay.
And what's nice about those is oftentimes they find additional security, like safety features in the home, and then it adds discounts.
Like fire suppression systems, things like that.
Exactly. Automatic water shutoff valves, residential sprinkler systems, central fire and burglar alarms, and so on.
Yep. That makes sense.
And so while we, let's say we have the dwelling value at $2 million, okay? Well, a premier company is going to give you something called guaranteed replacement. And what that means is exactly what it sounds like. There's no cap. They're going to guarantee they're going to rebuild that home to like, kind, and quality. And they stand by their word.
Interesting. So let's say we have the policy value says, hey, we'll replace it up to this point, but the actual market for construction costs have inflated up to this point, the insurance carrier says, even though the policy is valued here, we will meet at whatever the market replacement value is on a guarantee basis.
And to keep it as customized as your home. So some very high-end homes might have a lot of customized features, right?
Sure.
They might have items that have been imported from Europe. Well, Chubb is going to get those items that have been imported from Europe. They're going to try to replace those as best they can. And so it's not so much off the shelf. It's very customized. And yeah, there are different factors that can impact the replacement cost of homes. Like, let's say there's a large fire in the neighborhood and many homes come down. Well, all of a sudden there could be a shortage in contractors, and that can drive up the price.
Sure.
Right? And so there could be unforeseen circumstances that end up creating a situation where it's going to cost quite a bit more to rebuild your home than was expected. And so it's guaranteed. And then the other part of that is, instead of just having a guaranteed contract, it's nice to have another option, which is called a cash settlement option. And what that means is, let's take a $2 million home, burns to the ground. It's going to cost $3 million to rebuild. Okay. Well, maybe they want the insurance company to rebuild that home for $3 million. Or maybe they say, we didn't want to live here anymore anyways, and we want to sell this land and we want to move to Hawaii. So instead of taking the rebuild cost, when you do a cash settlement, when you cash out, you can take the dwelling value that's listed on the contract as a form of payment and walk for it with a check, and then you can sell the land. And so a cash settlement feature is just really nice because it gives you the flexibility to do what you want. Do you want to rebuild the same home, or do you want to take the cash? And I just think that clients really appreciate that flexibility.
Super interesting. Super interesting. Sophie, for clients that have kids that are going off to college, this is something I remember I was interested in when we talked before. Children are leaving to go to college. How do they want to view or modify their insurance portfolio based upon those family changes?
Another question I get a lot, as you can imagine. So the first thing I would recommend for folks is to notify your insurance agent.
Okay.
Really, with any changes to your insurance portfolio, it's always best to notify the carrier so they can note your files, right? Because at the end of the day, insurance is a contract between the insurance company and the insured, right? And you're transferring your risk in exchange for premium. And so the more information an insurance company has, the smoother a claim is going to be handled, is what I've found in my experience. And
no surprises that way.
Right, no surprises. And if there's a change in your situation, just send them a note. You can send me a note and say, hey, my kid is going to college in a few months. What should I do? Right. And so the first number one is notify your agent. And then the next thing to mention is, as a brokerage firm, we have access to so many different companies, and all companies are going to handle different situations in their own methods, and how in a way that works for their underwriting and so on. So one, I'll kind of break it down to mention that one thing that we typically see on auto policies is that when you have a student who is going away to college, there are a couple different discounts that can be added. One is called, it's interesting. One is called a distant student discount. And it's really neat because what that is for is, it is essentially a way to tell the insurance company, hey, my kid is going away to college. They're not taking a car with them. They're going to come and visit. They're going to drive on holidays. They're going to drive in the summer, but they're not a regular daily driver anymore.
The risk has been reduced, and as a result of which the insurance company offers a discount because that person's not there to drive the vehicle on a regular basis. Thus, the frequency of risk, a potential risky outcome, is reduced.
Exactly. And I really appreciate that because, I think that makes a lot of sense overall, right? And it gives you the comfort of knowing they're still listed on the policy, they're a listed driver, but you're just not paying such of a substantial amount of premium for them. So if they're not, when you say my kid's going to college, there's a couple questions, right? One, are they taking a car or not. If
Sure.
they're not taking a car, the distant student discount will apply.
Okay.
And if they are taking a car, then we still need to note the files. And so most of our underwriters will say, what's the school, what's the garaging address? Which vehicle are they taking, right? And so we say, okay, this, the Honda is going to Boston. It's still going to be registered, A lot of times, if it's a temporary situation, you don't always have to change the registration, right? So it might still be registered in Washington, and they're driving it over. They're not actually getting, let's say they're going to college in Boston, they're not necessarily having to get a Massachusetts auto policy. You can still have it on your Washington policy, which typically keeps it more cost effective.
Yeah.
And then just list that vehicle at a different garaging address.
Interesting. Yeah, to your point on just information sharing, I don't think that's folks' initial inclination is to share more information with their insurance company. But now hearing you talk about that distant driver discount, I imagine that most families are probably walking right past this savings and not even taking advantage of it.
Yeah, that's a good point.
So super interesting.
Oh, and one more point there.
Yeah.
The good student discount, which most folks start receiving once their children are licensed, assuming they are getting a 3.0 GPA or higher. The insurance company typically will want documentation for that, but they're not going to continue to ask you and hound you for that. They just need it one time. They send them the most recent transcript, report card, and they will add that credit to the policy. Well, that still applies for college and for med school, graduate school.
Wow.
That good student discount continues to apply. So in a way, you might have a significant savings when you have your child away at college without a vehicle and they get a good student discount, because then they're getting both those discounts.
You could be raking in the savings.
Yeah, and you just you gotta remind them that they need to keep their grades up.
Yeah, absolutely. More incentive. I like it. Thank you. Sophie, the other one I wanted to ask you about, and I think this is something that we've observed happening a lot over the last couple of years. If clients or families are purchasing a vacation home or a rental property, and I think maybe it might be helpful also to understand the distinction between a full-time rental, maybe Airbnbs as well. I know that's become a really popular investment strategy for some families. How do I want to think about, how does my insurance change if I buy a vacation house? How does my insurance change if I buy a rental property or an Airbnb?
Great question. Well, I would say we want to break it down to a couple different areas to answer this question. One would be, if it's going to be a secondary home, like a vacation property that's just for you and your family, it's very simple. You just add another homeowner's policy and you have it rated as a secondary home. So
Okay.
you buy a home in Arizona, your primary is here in Washington. We'd add a Arizona homeowner's policy for that location, and it'd be listed as a secondary. And then that home would be listed on your personal umbrella for excess liability as well. Whether or not the home is rented to others is going to be kind of the deciding factor on which policy form that we place it on. So a secondary home, vacation home, is just another homeowner's form. A home that's rented to others, some insurance companies have that on something called a landlord form, and the policy is actually a little bit different.
Okay.
And then the next question on, a secondary vacation home is a bit more straightforward, right? And then if you're buying a home as a investment property and it's going to be rented to others, there are a couple different questions that we need to really understand in order to adequately protect you. And that is, the first question is, okay, if it's going to be rented to others, is that going to be on an annual basis where they are going to sign a lease? You're going to recommend renter's insurance for the tenants.
It's like a full-time, normal, traditional rental property.
Exactly. And those are quite straightforward and simple to insure as well.
Okay.
And so we would put that on a landlord policy form. And again, the umbrella would extend over that, and we would indicate the fact that that is a landlord policy.
Got it. So let's say I have a rental property in Arizona. I have my own individual homeowners policy on that. And then I also have my excess liability umbrella policy would also carry over coverage on top of that as well.
Exactly.
Okay.
Exactly. And then if you have a policy that a home that is rented to others, whether it's an annual rental or a short-term rental does make a big difference.
Okay.
And the reason being, the shared economy. So let's think of Airbnb, VRBO for homes, Uber with vehicles, Lyft,
right,
that sort of thing. The shared economy has been growing in popularity over the years. But insurance companies are known for being a little antiquated and not always the best at keeping up with the times. We continue to push for changes to the contracts. I'm always like, hey, when are we going to be able to accept this exposure, right? And so at this point, a short-term rental that is listed on a vacation rental website, such as Airbnb, it's a common one, that is going to be tricky with many insurance companies, but luckily we do have markets that will insure them, right? So it's one of those things where it's not like a one-size-fits-all. Some of the premier companies that we work with that are more have more sophisticated contract language and I would say, broader coverage overall, they are a bit more hesitant to kind of play in that space of short-term rentals. And so what can happen is they might say they don't want to be on that exposure. Well, if that happens, the nice thing about working with a brokerage firm is that we can then move that. We can kind of solve for that problem. So, for example, Safeco Insurance is a company that in the last few years opened up their appetite for that business. Okay. So they have a nice product, good coverage. I can put that short-term rental with Safeco, and then it's still within one agency. We've just had to kind of move that piece out. So it's one of those things that each situation we approach uniquely. We go to the underwriter, and it's not a one-size-fits-all approach with insurance. We could go to our underwriter on one account, and they say, yes, we're going to make an exception on this. This fits our appetite. In another account that has a very similar exposure could be declined. So it's really beneficial for a client to work with an agent who is going to multiple carriers on their behalf to see, what we can do to best protect them.
So I think that's interesting because most folks would probably default to, I want to bundle, right? And I think a lot of insurance companies want you to bundle. I want to get all my coverage to the same place. But what I'm hearing you say, Sophie, is that it actually might be beneficial for me and my insurance portfolio to say, I'm going to have my homeowner's policy here. And for my 3 Airbnbs, that could be covered with a completely different company.
Right, and that might have to be the case. I will highlight that a premier insurance company does tend to want to provide a holistic portfolio, and so they oftentimes will require primary home, auto, and personal umbrella to be consolidated. Yep. So it's usually to kind of be able to work with these companies, they're going to require 3 lines of business.
Yep.
And besides that, if we have to break off a policy, a boat or this or that with another company, that's no problem, and we can solve for that.
That makes total sense. Last question I wanted to ask you about was for households that have valuable art or jewelry or collectibles of some kind. For my collection of Monets that I have in my other room right here, how do I want to approach protecting my valuable belongings?
Great question. Well, I like to break it down for folks so they really kind of understand where the coverage is stemming from, what they want to transfer to an insurance company to insure. Because at the end of the day, we are looking at risk transfer, right? And so I do have some clients that might have a large jewelry collection and they only want to insure 50% of their collection. They're happy self-insuring 50%. That's fine. It's we want to think about your risk tolerance when we're looking at your valuable articles. And so The first thing to mention is that on a homeowner's policy, you know how we mentioned there's dwelling replacement value, there's personal property, which is the contents. Well, within a contract, on the personal property section, there's going to be an area that is usually called special limits of insurance. And that means that within the coverage for your contents, there might be a few areas that the coverage is limited. And to have full coverage, you need to add it separately, whether that be as an endorsement or a separate valuable articles policy. And so for example, you know, your policy will say it has $1 million of contents of personal property on your policy. And it's replacement cost, new for old. There's a deductible that a claim is subject to. And within that million, it might say the most we'll pay for jewelry is $10,000 in a loss. The most we'll pay for firearms is $10,000. Same with like silver or china collections. And so there are certain items that have limited amounts of coverage. And then there's the deductible that applies. So if you have, a lot of times our clients will take a high homeowner's deductible and self-insure smaller losses. It also helps to keep the premium more competitive, and we're in a hard market, so we want to protect your insurability. So if someone has a $10,000 deductible on their home, and then their jewelry is limited to $10,000 on the contract,
it's a wash.
Claim, it's a wash.
There's no point. Yeah.
So what we do is we want to look at a collections, also known as a valuable articles policy. And the benefit of one of those policies is that not only will it provide full coverage for your items, on a scheduled item such as a, let's say an engagement ring that's insured for $50,000 on the contract. It's going to be worldwide coverage with all of these premier insurance companies that we represent. It's going to be worldwide coverage, mysterious disappearance, theft. It's a very broad contract for all of these. Everything is covered except for a handful of excluded items. And when you schedule a piece of jewelry, that essentially means you're telling the insurance company exactly what it is. We usually like to have an appraisal. If we don't have an appraisal, a receipt is good to have. If we don't have that, we can do a description and a value. So, we want to be as specific as we can. We put that on the policy. Let's say it's insured for $50,000. Well, the contract will give you 150% appreciation for the market value. And so, market value appreciation is a nice thing to have on jewelry because oftentimes, the cost of gemstones and gold, different metals can increase. And so if you're traveling and the diamond falls out, for example, and you file a claim and to replace that exact same ring would be more than $50,000, they're going to give you 150% of what it was insured for.
Interesting.
If it's warranted that the value has increased. So it's kind of nice to have that little buffer there. And then the other one is that it's zero deductible on a valuable articles policy. And the claims are typically settled very quickly. I've had some clients who, a Rolex was lost or stolen and the insurance company has the check in the mail the next day. So it's been, it's a policy that it's beneficial to have if you do have a lot of high value items that you want to protect. And jewelry being one of the most common. And then, fine art is an interesting one to discuss. Some of our clients have extensive art collections. And, one thing is always wise to have your high value items appraised to really understand what they're worth. And then when you are looking at coverage for fine art, the rate is much less expensive than jewelry because the chance of a loss is lower.
I'm not taking my collection of Monets on my cruise with me and accidentally dropping them into the ocean, but my watch or my ring, I could.
Exactly. So jewelry has a higher rate to insure than fine art with every insurance company that we represent.
That makes total sense. I could see how this component of valuable belongings, art, jewelry, etc., could also be another piece that's fairly overlooked as well as, as you progress your life. Okay, maybe you get a couple nice watches, you replace upgraded engagement ring. Next thing you know, you've got probably well in excess of, let's use your example before, of $10,000 of jewelry that's covered on your homeowner's policy. You could have substantially more than that across all those different types of belongings.
Totally, and it's a way to protect your investments, right? Like we'll have quite a few clients that are, investors in fine art or in high-end jewelry, and should there be a loss, it's important to financially protect yourself as well.
That makes total sense. Awesome. Sophie, that is all we have time for today. I just want to thank you so much for joining and helping to educate our clients about their insurance portfolio and some potential areas that they might be overlooking. So we really appreciate your time, really appreciate your expertise. I'm going to make sure if anybody does have any questions, they want to connect with you, that all your contact information is in the description below. So for anybody that does have any questions, we've had clients work with Sophie. Her team is fantastic. So we'll make sure that her contact information is below for anybody that wants to do that. Sophie, thank you so much again for your time, and for everybody listening and watching, have a wonderful day. Thank you very much.
Thank you so much.